One of the core principles of having good financial planning is having an asset allocation that's suited for your age and your risk tolerance. In today's video, we're gonna go over every single decade of what your portfolio should look like, and we're gonna have 3 different risk profiles per decade, so that's gonna be risky, moderate, as well as conservative. Before we start, I just wanna say that the proper way to allocate is going to be different for everyone. However, this video will serve as a good general guideline for most people. If you wanna just skip around to the asset allocation part of this video, I'm gonna leave timestamps in the description for you guys so that you can do that. But for now, let's talk about risk profiles and how to figure out what your risk profile is. For the riskier investors today, we're probably going to be weighted heavier in stocks in our portfolio, especially into the ages of the 40s and maybe even the decade of the 50s. The reason is that stocks have been outperforming bonds for over 100 years now, and while stocks are inherently riskier, they still provide a lot of upside to our portfolios. Looking at this graph from Darrow Wealth Management, we can see the backdated returns of $10,000 invested in 2012 in the S&P 500 versus various bond funds and their total returns. The S&P 500 ETF produces about a 3.2x return over these 10 years, bringing the total balance to $32,550. We can see that the bond funds, the best one produced returns of around $15,600, and the rest were smaller than that. Now, historically speaking, stocks on average have been returning about 9 to 10% per year since the inception of the stock market, versus bond yields are usually much lower. However, we can see with this bar chart that not every year does the market return positively. If we focus in on the past 50 years, we can see that the trade-off for the 9 to 10% average returns that we are accustomed to is the fact that there are often down years of upwards of 30% or more. So with that being said, here are 3 characteristics of investors that this riskier profile might suit. Number 1, if you're young and you have a long time horizon until retirement, the riskier profile might suit you. Number 2, it'll also suit those people that have a reliable source of income that's going to grow considerably over time, and those are the people that aren't going to rely on their investment income from their retirement fund in retirement. And number 3, you might be someone who likes to actually manage their money and check out what the stock market is doing on a day-to-day or week-to-week basis, and you believe that your picks can actually outperform the market. In any case, the riskier risk profile that we're talking about today takes into consideration that you're okay taking a short-term loss or perhaps accepting some risk in the pursuit of longer-term wins. As we approach retirement though, we might actually shift our strategy from more of a riskier approach to a conservative one where we focus more on capital preservation. What's interesting though is that according to a 2020 Vanguard study, millennials actually allocated 90% of their portfolio to equities versus baby boomers maintained an equity position of around 66%. That's just a really good proof point that things actually do change as we age, and most reasonable investors are shifting their risk profiles as they age throughout the years. Okay, the next profile is if you're a moderate investor. In the moderate approach, our portfolios will still consist of 50 to 60% in stocks by the time we retire. If you're a moderate investor, you generally have the following characteristics. So number 1, you want to grow your money with a balanced approach. And number 2, you're okay tolerating some losses because you kind of know that's part of the game, and to get any risk, especially later on, you might have to take some losses in the short term. According to Vanguard, a portfolio with 60% in stocks and 40% in bonds had an average return of 8.6% from 1926 to 2018, but there were still some years in which this portfolio actually lost 20% in a single year, and that the probability of a 10% loss in any single year was still close to 40%. Also, it's interesting to note that most Americans out there actually take a moderate risk level approach, and the median exposure to stocks in 2020 across all American households was over 63%. I also just want to say that the moderate risk investor profile has been a lot hotter in this past decade, especially because bond yields weren't really returning that great, especially in the past 15 years or so. It's really only been in the past year or 2 that the bond yields have started to make a difference again in most people's portfolios, and so likely you're seeing a very slow shift toward the moderate to conservative side of risk profiles once again. Okay, the third approach today is the conservative approach, and this is the most conventional school of thinking when it comes to retirement, and usually has to do with the rule of 100. This is an older rule that actually tells you that you should take your age and subtract it from the rule of 100 to get the percentage of allocation of your portfolio in stocks. So if you're the age of 40 right now, for example, you would take 40 and subtract it from 100 and you would get 60. So 60% of your portfolio should be in stocks when when you're the age of 40. That means the remainder is going to be in bonds, and the reason why bonds is good for someone that's a little bit more conservative is that they're usually less volatile than stocks. Especially in times of market turmoil, bonds typically tend to outperform stocks during those periods. So take a look at this graph from Darrow Wealth Management again. From January 2020 to January 2021 during the pandemic, we can see that the S&P 500 total return underperformed treasuries and corporate bonds for the majority of the year when the stock market was in turmoil. The bonds held steady for the most part, and even when the market had a flash crash in April, their swings were definitely less volatile. Okay, so this conservative asset allocation risk profile is really good for the following person with these characteristics. Number one, someone that just wants a simple conservative approach and doesn't really want to worry about what's going on with the market every single day. Number two, these are people that believe in the rule of 100 or maybe even the rule of 110. Number three, these people are risk averse. They're probably more focused on capital preservation, and this is probably the risk profile that you want as you get closer to retirement. All right, so let's get into the decades now, starting in our 20s. So in our 20s, we want to be as aggressive as we can be because we have the most time left until retirement. Most portfolio managers would agree that you want to be aggressive by having 100% in equities at this age and then slowly reducing that volatility over time. And I believe in your 20s, you definitely should be a riskier investor. I mean, you just saw all the data about stock market returns beating bonds historically over the past 100 years. And in your 20s, you have the most time left until retirement, so it definitely makes sense to be aggressive. All right, so here are some sample allocations for you in your 20s. If you are on the riskier side, you're gonna wanna be 100% in stocks and 0% in bonds. The assumption here being that if there is a stock market pullback in the next 10 or 20 years, you still have a lot of time to regain that lost ground. If you're more moderate, you might go 90% in stocks and 10% in bonds. And then if you're conservative and you're in your 20s, you might go 80-20, so 80% stocks, 20% bonds, but it's not something that I would probably go with. Now, in terms of what to invest in when it comes to stocks or bonds, we're going to be investing in index funds that track the stock market index or index funds that track the bond market index as well. Some ticker symbols of great index funds for stocks include VOO, VTI, and SPY. For your bond funds, you can go with something like BND, AGG, or even Vanguard's tax exempt bond fund, which is ticker symbol VTEB. All right, so now you're in your 30s, and this is likely when you're starting to get spread thin. If you are not already, you probably have a mortgage, you might have a family, or you're starting to think about a family, and you just generally have a lot more responsibilities on your plate. Even with all these things going on, you should still be prioritizing your retirement contributions, especially because this is the most important time in your life. It's your 30s and your 40s because these are your prime earning years. Now, in my opinion, in your 30s, you can still afford a lot of risk because you still have a lot of time left until retirement, and it's been actually shown based on data that over any 20-year rolling period that the stock market tends to return positively. Okay, so if you're risky in your 30s, you're still looking at a 90 to 100% allocation of stocks and between a 0 to 10% allocation in bonds. If you're super risky, that allocation might not even change from your 20s. When you're moderate, you can consider an 85-15 split, so 85% in stocks and 15% in bonds. And then if you are conservative in the decade of your 30s, then that might be a 70-30 split. Now, caveat here is as you age through any of these decades, you can start to shift your asset allocations as you get closer to the end of that decade. So for example, going from the age of 30 to 35, let's say, maybe at the age of 30, you're 90% in stocks, but then by the time you're 35, you can reduce that allocation of stocks to maybe 85 or 80%. That all just depends on you. The main thing to always be thinking about in this case is your time horizon and your financial independence number and how close you are to your goals. If you think you'll need the money within 20 years, or you think you're gonna retire early, that might be a good time to start shifting some of your assets away from stocks just because you wanna go with a more conservative approach. However, in my 30s, personally, I'm still focused on growing my nest egg as big as possible. So personally for me, I'm still very much focused in on stocks and staying aggressive throughout my 30s. The other thing that you should be doing in your 30s is to take advantage of any tax advantaged retirement accounts. And if you haven't been doing that already, make sure you're doing that. I have a lot of videos on that on my channel. All right, so as you enter your middle ages and you're now in the decade of the 40s, these are still your prime earning years, but you might have bigger savings goals like sending your kids to college and paying off that pesky mortgage. Depending on when you plan to retire, that's when you might want to add more stability in your portfolio by shifting more of those equities into bonds. Just like I said at the end of the decade of the 30s, the sooner you want to retire, the sooner you should be thinking about shifting your asset allocation. Now, here are some asset allocations based on the risk profiles for this decade. So for the riskier 40-year-olds, you want to be be in 85% stocks and 15% bonds. For the moderate risk profile, we still want the majority of our allocation to be in stocks because we still have a lot of years left to ride out any volatility. So I'm thinking 75-25. And for the conservative approach, we're gonna go with a 60-40 split between stocks and bonds. If you remember my rule of 100 from the conservative section earlier, that's exactly what this is. Again, take these with your own personal situation in mind. If you're still 20 plus years out from retirement, you probably could still afford to go with a moderate or even a risky approach. All right, as you enter your decade of the 50s, this is when you should start thinking about, okay, it's going to be time to retire in the next 10 to 15 years. So the most aggressive that you should probably be in your 50s is going to be something like an 80-20 split, and even that seems a little bit too risky in my opinion. The more moderate approach has us at 70-30 for stocks and bonds, and the conservative approach has us at 50-50. Your nest egg by this time should be shaping up quite nicely. Now, the average 401k balance in America in the decade of the 50s is $179,000. We should be aiming to be way above that. Ideally, we're contributing about 15 to 20% of our paycheck into savings and retirement at this age, as well as the fact that we're trying to capture as much upside as possible while trying to reduce our risk. That's easier said than done, but the idea is that we don't want to be risking everything here, and capital preservation becomes more of a priority in our 50s and our 60s. With 15 years left until retirement, there are plenty of 15-year stretches in the stock market where you could still lose some money. You can actually see with this dot plot that the US stock annualized real returns over 15-year rolling periods, some of these data points can be negative. In fact, looking at the distribution of stock market returns over 146 years of data, the chance of seeing negative returns for any given year is about 31%. That means 1 out of every 3 years could be a losing year. Still though, even with that fact, your 50s are still not the worst time per se to be invested in stocks, because over any 10-year rolling period, we still usually see positive gains. There's a maximum return of 17.6%, a minimum return of negative 4.1%, and an average of 6.9% returns in the market. If you'd like to see how the US stock market has fared in any rolling 1, 5, 10, or 20-year period, this article is really good and it details that, and I'll leave a link for it down below. But now let's get into your 60s, because this is the decade where retirement age usually strikes, which is a great thing. Once you hit this decade, your asset allocation likely shifts way more towards bonds and less into equities, as well as you might add some more cash. Now, if you haven't retired yet, you can still make contributions to your 401k and hopefully get that employer match. And the idea here is you just want to buff up your nest egg before you actually retire. In the risky profile in your 60s, I would first question, why are you still risky in your 60s? But if you happen to be risky because you might need to catch up, or perhaps you don't even need your retirement funds to have a good retirement, aka you're already really rich, then I would kind of understand. But the risky profile person would have 75% in stocks and 25% in bonds at this age. However, most retirees will probably be in the moderate or the conservative approaches for this age group, especially because they're relying on their nest egg for retirement. A moderate risk profile at this age might have 60% in stocks and 40% in bonds, and a conservative risk profile would have 40% in stocks and 60% in bonds in your 60s. As the retiree ages past age 70 or even 80, then you're going to start to see that shift in stocks go all the way down to 20, 15, or even 10%, and the shift in bonds go upwards of 80 or 90%. This is assuming your safe withdrawal rate of 4% per year, and hopefully your nest egg with investments can cover that safe withdrawal rate and more. If your investments can't cover your safe withdrawal rate and you're already the age of 65, for example, you unfortunately might have to work for a few more years, or you might have to go a lot riskier, and that might be a dangerous thing. Okay, so how do these different portfolio asset allocation compositions kind of perform? Fidelity actually did a study at the end of 2022, and I'm going to show you the results right here. All right, so we can see the impact that asset allocation has over different average annual returns and also the worst possible returns. Of course, this does include the 1929 stock market crash and depression, as the data is from 1926 through 2022. In this chart also are short-term investments. They are 30-day treasuries. So for the sake of my points today, I'm going to simplify these pie charts. So you can feel free to pause the screen and to see how these portfolios performed over different periods of time, and also link this study in the description below for further reading. What's also fascinating is that the worst 12-month return is minus 61% or close to that, and the best 12-month return is around 136%. Now these are over 12 months, so just like the data, as I said earlier, if you go over a longer term time horizon, let's say 5, 10, or 15 years, then these returns are going to converge slightly more to the mean. You can see that in all these approaches, the worst 20-year return annualized is still going to be positive, which is actually a really great sign. All right, so asset allocation is definitely a highly personal decision. However, I hope this video gave you a general guideline on what you should be looking for. Your goals might change throughout your life, and your asset allocation as well as your risk tolerance might change as well. If that's the case, you can always come back to this video, reference what I've said in today's video. It should be pretty standard. I will also leave some links down below for you guys to check out after this video. Let me know what you guys thought of today's video. Check out my next video on investing right here, which I'll leave up, and I'll see you guys in that video, or I'll see you guys in the next future video. All right, thank you for being here. Peace.